I held JEPI for nearly 3 years, and in mid-2025, I finally moved on. Not because it is a bad fund, not because something went catastrophically wrong, but because when I sat down and ran the real numbers, total return, tax treatment, payout stability, the data told me something I could not ignore. And the honest truth is, I probably should have made the move sooner. Today I am showing you exactly what I found, why it changed my decision, and what all of it could mean for your income plan, depending on where you are in your financial journey. This is JEPI versus SPYI, the full breakdown, nothing held back. Welcome to the Dividend Desk, where we build income strategies for real life. If you are new here, the philosophy of this channel is simple. We do not chase the highest yield. We do not jump from fund to fund based on whoever posted the biggest distribution number last month. We invest in funds that are built soundly, that fit a long-term plan, and that we can hold through both good markets and bad ones without losing sleep. I come from a background in data and planning, and that means every decision we make goes through a real analytical process before we act on it. What you are going to see today is exactly that process, applied to one of the most common questions in the covered call ETF space right now. And before we go any further, the standard reminder: this content is for educational purposes only and is not financial advice. All investments carry risk, including the potential loss of your capital. Past performance does not guarantee future results. Please consult a qualified financial professional before making any investment decisions. Now let us set the context first, because I think it matters enormously for understanding why this conversation is even happening. When JEPI launched back in 2020, covered call ETFs were still a relatively niche corner of the investment world. There were fewer than 15 of these funds in existence at the time. Today, there are over 100. JEPI came in early, drew massive investor inflows, and built itself into one of the most recognized income funds in the space. Right now, it sits at approximately $41 billion in assets under management. SPYI, by comparison, is younger, smaller, and sitting at around $6.3 billion in AUM. On paper, JEPI looks like the safer, more established choice. Bigger, more institutional, lower fee. And for a long time, that perception held up. But in 2025, the performance gap between these two funds became impossible to ignore for serious income investors. And that is exactly what triggered this deep dive and ultimately the decision to move. So let us start with the fundamental structural difference between these two funds, because everything else, the performance gap, the tax treatment, the payout behavior, flows directly from how each fund is built at its core. JEPI is what I would call the defensive approach. It does not hold the entire S&P 500. Instead, J.P. Morgan hand-selects a smaller group of stocks, somewhere between 100 and 130 names, specifically chosen for their lower volatility characteristics. The idea is to smooth out the ride, reduce the big swings, and create a more stable income stream. On top of that, JEPI generates its monthly income through a structure that uses equity-linked notes, ELNs. These are special option contracts and notes that sit alongside the equity holdings and produce the income that gets distributed to investors each month. That ELN structure is important, and we're going to come back to it when we talk about taxes, because it has real implications for what ends up in your pocket after the IRS takes its share. SPYI takes the opposite approach. It is more aggressive in the sense that it holds all 500 stocks in the S&P 500, the full index, every name, every sector, every winner, and every laggard. It does not self-select. It does not try to reduce volatility by leaving certain stocks out. What it does instead is write index options on top of those holdings to generate income. Not individual stock options, index options. And that distinction matters both for performance and for how the distributions get taxed. SPYI is essentially saying, give us the whole market, and we will generate income on top of it through the options market without sacrificing the full breadth of market participation. Now here is where that structural difference shows up in the real-world numbers, and why 2025 was the year that forced this conversation across the entire income investing community. The S&P 500 as a whole returned 17.72% in 2025. A meaningful chunk of that return was driven by a relatively small number of large technology companies that had an exceptional year. If your fund owned all of those companies, you captured most of that return. If your fund had self-selected a smaller group of names specifically chosen to be less volatile, which often means underweighting or excluding some of the high-flying tech names that drove the rally, you missed a significant portion of those gains. And that is exactly what happened. SPYI delivered a total return of 16.67% in 2025. JEPI delivered 8.09%, the same underlying index. A gap of more than 8 percentage points in a single year. That is not noise. That is the structural consequence of the defensive approach running headfirst into a market environment where concentration in a handful of aggressive growth stocks drove the majority of returns. When you look at it purely from a price appreciation standpoint, the picture is even starker. The S&P 500 price return was 16.35%. SPYI tracked it closely at 3.36% price return. Remember, covered call ETFs will always experience some capped upside on the portion of the fund where calls are being written, so you expect a discount to the pure index return, and 3.36% reflects that reasonably well. JEPI's price return was just 0.50%, half of 1%, in a year where the market was up over 16% on price alone. Now, I want to be clear. Income-oriented investors do not expect covered call ETFs to match pure index performance. That is not the point of these funds. The whole value proposition is that you are trading some upside participation for consistent monthly income. That is a completely valid trade-off, depending on your goals and your stage of life. But there is a baseline expectation that these funds should at least track the directional behavior of their underlying index. And an 8% total return in a 17% market is a gap that goes beyond normal covered call mechanics. It is the structural consequence of leaving the biggest winners on the bench. Now let us talk about the income side of this equation, because for most people watching this channel, the monthly distribution is the whole point. And this is where I think the nuance really matters, and where a lot of investors are not asking the right questions when they evaluate these funds. SPYI's monthly payouts have been remarkably steady. Over the last 3 years, the average month-over-month adjustment has been essentially neutral. The biggest single-month increase has been around 10%. The biggest single-month decrease has been around 9%. That is a relatively tight band of variability, predictable enough that you can actually build an income plan around it with reasonable confidence that your check next month is going to look a lot like your check this month. JEPI tells a very different story. The average month-over-month adjustment since inception has been around 2%, which sounds manageable until you look at the extremes. The biggest single-month increase has been 56%. The biggest single-month decrease has been negative 52%. Over 50% swings in a single month. For someone who is relying on this income to cover rent, utilities, groceries, and the basic costs of living, that kind of variability is genuinely difficult to plan around. If your baseline monthly expenses require $4,000 and your distribution swings from $5,000 one month to $2,400 the next, you need a very significant cash buffer just to smooth out the ride. And that cash sitting on the sidelines waiting to cover the low months is cash that is not compounding anywhere. There is also a secondary effect here that I think gets overlooked. Distributions come out of the fund's net asset value. When a fund pays out a large one-time distribution, the NAV absorbs that payment. So a fund with wildly inconsistent payouts, big ones some months, small ones others, is also creating NAV volatility that makes it harder to maintain consistent future payouts. I watched this play out in real time last year when I was evaluating a potential shift from QYLD and XYLD into their growth-oriented alternatives, QYLG and XYLG. Those funds had a pattern of paying out large distributions at the end of the year inconsistently, and every time they did, the NAV fell by a corresponding amount. The big distribution months looked fantastic on paper, but the income inconsistency and the long-term NAV pressure did not fit what we were trying to build. And that experience sharpened our thinking enormously about what payout stability actually means and why it matters as much as yield. Now let us talk about taxes, because this is the piece that I think is most underappreciated by income investors, and it is genuinely one of the most important reasons behind our decision to move away from JEPI for our S&P 500 exposure. JEPI's ELN structure means that the majority of what it pays out is classified as ordinary income. It is clean, it is predictable, there are no surprises at tax time. You know going in that this income is going to be taxed at your ordinary income rate. For some investors, particularly those in lower tax brackets or those holding these funds inside tax-advantaged accounts, that straightforwardness is actually a feature. You know exactly what you owe and you plan for it accordingly. But for early retirees living off a taxable brokerage account, which is exactly our situation, ordinary income treatment on every dollar of distribution has a meaningful real-world cost. SPYI uses index options to generate its income, and that creates a different and often more favorable tax treatment. Some of those distributions qualify for Section 1256 contract treatment, which means they are taxed at a blended rate rather than your full ordinary income rate. And some distributions from SPYI may come through as return of capital, which, as we have talked about on this channel before, is not a negative thing. It is a tax deferment that adjusts your cost basis and pushes a portion of the tax liability into the future rather than hitting you today. Let me give you a concrete example of what that difference looks like in real dollars. Take someone who is 50 years old, earning $100,000 in regular wages, and pulling an additional $40,000 per year from a covered call ETF position. In scenario 1, that $40,000 comes from JEPI and is taxed as ordinary income. In scenario 2, that same $40,000 comes from SPYI with its more favorable tax treatment. At the federal level alone, without factoring in any deductions beyond the standard deduction, scenario 1 results in just over $23,000 in federal taxes on the combined income. In scenario 2, the estimated tax savings from the more favorable treatment on that $40,000 of SPYI income is approximately $9,400 per year, nearly $10,000 every single year. That is not a rounding error. That is a real and significant difference in how much of your income you actually get to keep and potentially reinvest, and it is entirely a function of fund structure, not yield. Now I want to address track record because this is the legitimate argument in JEPI's favor, and I think it deserves a fair hearing. JEPI launched in 2020 and lived through the 2022 market downturn, a real full bear market, and in that environment, JEPI's defensive strategy genuinely proved its value. When the broader market was falling hard, JEPI's approach of holding lower volatility names and generating income through ELNs provided meaningful cushion on the downside on a total return basis relative to the S&P 500. That is real data showing the defensive strategy doing exactly what it was designed to do. SPYI, on the other hand, launched in August of 2022, essentially right at the tail end of that bear market. It has not been tested through a full, prolonged market downturn the way JEPI has. That is a genuine gap in the historical record, and it is worth acknowledging honestly. What we do have for SPYI is its behavior during the market volatility in April 2025, when the back-and-forth tariff cycle created a sharp and rapid drawdown. If you look at April 8th, which was the lowest point during that period, JEPI actually had SPYI beat on total return by about 3%. The defensive strategy holding up slightly better during the sharpest part of the decline, exactly as you would expect. But here is what happened next. By May 20th, just 6 weeks later, SPYI had not only caught up to JEPI but overtaken it on total return for the year, and it did not look back. The recovery speed and the upside capture more than compensated for the slightly larger drawdown during the worst of the volatility. And that pattern, modest underperformance at the very bottom, followed by meaningfully faster recovery, is consistent with what you would expect from a fund that owns the full index rather than a curated defensive subset. So what did we actually do? JEPI was one of the first covered call ETFs we ever bought back in 2022. It was an early position, it served a purpose at the time, and we held it for nearly 3 years. In mid-2025, we moved that full position to SPYI. We also added GPQ, which keeps JP Morgan's income approach and lower volatility exposure, but applies it to the NASDAQ 100 rather than the S&P 500. Alongside QQQI from NEOS on the NASDAQ side for the same reasons we moved to SPYI on the S&P side. Full index exposure, income derived from volatility, and the tax efficiency advantages that come with index option-based strategies. The result is a portfolio that gives us JP Morgan's stability and income reliability on the NASDAQ side through JEPQ, and NEOS's full index participation with tax efficiency on both the S&P and NASDAQ side through SPYI and QQQI. It is a structure that feels right for where we are right now and what we are trying to accomplish. And I want to be direct about something. This is our choice based on our specific situation, our tax position, our income needs, and our risk tolerance. It is not a recommendation. JEPI is not a broken fund. For investors who are in higher tax bracket situations where the ordinary income treatment is less of a burden, or for investors who want the most defensive possible approach to income investing and are genuinely willing to sacrifice upside participation for stability, JEPI may still be the right tool. The decision always has to flow from your specific goals, your timeline, and your tax situation. If you are trying to figure out where you land on this, there are a few questions worth asking yourself honestly. Is your primary goal income, or is it income plus growth? Are you drawing from a taxable brokerage account where tax treatment materially affects your real return? How much distribution variability can you genuinely absorb without it disrupting your financial plan? And how important is it to you that your fund participates fully in broad market rallies versus protecting more aggressively on the downside? There is no universally correct answer. But asking the right questions is how you find the answer that is correct for you. For comparing funds on your own, stockanalysis.com is where we pull most of our raw data, and it is genuinely one of the most useful free tools available for this kind of analysis. And if you want a more structured framework to work within, the Income 360 guide covers over 80 income funds with detailed comparisons across yield, total return, payout stability, tax treatment, and fund structure. It is the tool we use with clients to cut through the noise and make decisions based on data rather than headlines. Everything is linked in the description below. The bottom line from everything we covered today is this. 2 funds can track the same index, pay monthly income, and look nearly identical on the surface, and still deliver dramatically different outcomes depending on how they are built, how consistently they pay, and how they are treated at tax time. Understanding those differences is not optional if you are serious about building an income strategy that works for the long term. Yield is the starting point of the conversation. Structure, stability, and tax efficiency are where the real decisions get made. If this breakdown helped you think more clearly about how to evaluate covered call ETFs, hit the like button and let us know in the comments which funds you are currently holding or which comparison you want us to tackle next. Subscribe so you do not miss the next deep dive. We will see you at the next one.